recorded and we are going to be uploading it on YouTube just so for some of our members that aren't able to make it. But we are going to start because I want to leave a lot of time for question. So you're welcome. This event is put together by Synergy Hangout. We're still expecting a lot more people to join the event today. It's all about taxes. I think I think there is a quote going on out there that there are two things that are certain, your debt and your taxes, right? We have to pay taxes. We pay taxes when we earn money. We pay taxes when we go out for shopping. We even pay taxes when we die. It's called estate taxes, right? So we have an expert in our midst today. I just want you to keep an open mind. He's an expert in the field. He's a certified public accountant. And I have a list of questions that I've gathered from individuals. So please be ready to learn. Like I was saying earlier on today, that just my meeting with Chukwudi earlier on in November kind of showed me a projection that I'm going to be owing the government about 7,000 in taxes, plus plus the ones that they've taken away from all my paycheck, you know. So this is going to be an information field event. So I'm going to leave it over to Chukwudi. So we'll have about maybe 30 minutes to share your presentation with us, and then we can move over to the question and answer. Thank you very much, sir. And we appreciate your time. So
Sure, sure. Good afternoon, everybody. Thank you so much for taking out time to come and learn, and also for me to learn from everybody's perspective. Thanks so much, Mr. John, for organizing such an event, and of course for inviting me. This is the second time I would be in your midst, and I'm so excited and glad about that. Um, yeah, so he has introduced me. My name, I am a certified public accountant. I'm certified in the state of New York and New Jersey, but also as a CPA, you have to be certified in one state, but you also have the ability to work in all 50 states. So that's one question I get all the time. Yeah, are you certified? Can you work in my state? I have clients from the state of Texas, Wyoming, Florida, and the like. So, but you just have to be certified in several states, but you can work anywhere. So my major background is taxation. So I specialize in taxes for individuals, in taxes for businesses, small and medium-sized business, most especially, ensuring that they are set up in the right structure. And I try as much as possible to go beyond just preparing the taxes to tax planning, meeting with clients to figure out what their tax liability would be and way to mitigate their tax liability. Apart from taxes, I'm also good with accounting. I'm an accountant. I'm a CPA, so I am an accountant. So, as an accountant, I assist small businesses in keeping their financial records and their books, because that is also a very important component of taxes. With tax accountants, we like efficient bookkeepers and efficient business owners that have a clean set of records and books, because it just makes our work easier and the rest of it. So some of the agenda I'll just go through today is a brief introduction to tax planning. We will discuss some of the reasons to tax plan. Then we'll discuss what to expect from the 2024 tax season. Then also final tips, takeaway. Then we'll have an interactive session with questions and answers, right? Perfect. So first of all, what's tax planning? It's very easy. See it as basically tax planning is basically trying to ensure that you are not paying more than you are required to pay. That is the long and short of the story. Just to ensure that you are not paying more than you're required to pay. By the end of January 2024, tax season will begin. To some, tax season means different things between that January to April. I know some of us that are on this call, we are looking forward to tax season because it means we're going to get that big refund. And I'm sure we are already making plans with our refund, probably to pay down our credit card debt, to make a big purchase and all that, right? To some, tax season is a time of anxiety. It will shock you to know the number of people that are just so anxious from tax season. And it's a case of if I don't think about it, it doesn't exist. I can tell you that there are people out there that have back taxes that have not filed for years. Not because they don't have income, but they are just anxious. Tax season just come with this level of anxiety. Why to some, the opposite of those expecting refund, some expect to pay back during tax season, right? So they always say, oh, I always pay back every year. I'm sure I will pay back this year. So they already have it in their mind that they'll pay back this year. It's okay. So whatever bucket you belong to, tax season doesn't have to be a time for anxiety. As a matter of fact, I see tax season to be more of a reinforcement of the fact and a reinforcement of the result which we've already calculated before tax season. In other words, before the end of the year, you should have an idea of what your tax season results would be. And tax season will just be, okay, let's make it happen. We already know this is what the results would be, and we just want to make it happen with tax season. That is the way I view tax season. For example, you should already know by now if you're going to get a refund and an estimate of the amount of refund you're going to get. You should already know by now if you're going to pay back and an estimate of the amount you're going to pay back. Obviously, just enables you to plan, to move money around if you need to, right? You should already know all those things by now. So that is just the summary of tax planning. The summary of tax planning is basically to enable us to prepare for the tax season and to also ensure that we do not pay more than we need to pay in taxes and just to get ready for the season. Now, the next question is, what is the reason to tax plan? Why do you need to tax plan? First of all, the obvious word is so that you don't pay more than you need to pay, right? I'll give you an example. Let's say, for instance, then also another reason for tax planning is to avoid surprises. You don't want to be caught unawares. You don't want to be caught unfresh. You always want to maintain your steeze and composure at every time, right? So take, for instance, you've always gotten a refund. Every year you get a refund. You're so excited. You've gotten a refund in the past and the rest of it. So do you expect that, oh, I've always gotten a refund. This year, I'm going to get a refund. There is no way about it. And maybe that year, and that happens to be the year you change to another person. Maybe you come to use me this year. And you're like, oh, you've always gotten a refund. And I do your tax planning. And I'm like, I do your taxes as a tax time. And I now see, oh, you owe about $5,000. And you'd be like, no way, it's not possible. I've always gotten a refund. I shouldn't have changed my tax preparer. Oh my goodness. Are you sure you know what you're doing? And the rest of it. Most times I say, okay, let's cool down. Let's bring last year and compare it with what I did. And there are times you now see the situation changed. maybe your income doubled. You didn't factor that your income doubled. It's possibly a case of you got a second job, and probably when you were making 50,000, now you're making 100K. And you tell them, okay, yes, I'm making 100K compared to 50K. They will now say, oh, yes, I know, but I was withholding. Okay, let's look at your withholding, compare it. So you probably got a second job. You didn't fill the right things on the W-4. That form you fill when you start a job, when you claim the number of exemptions and the rest, right? So there are usually different reasons. Maybe last year you were in school, you got the education credits, right? But this year you stopped school or you graduated, so you're not getting any of those credits. But right now you're surprised and you're shocked by that you're not getting a refund because you assume that you have always gotten a refund in the past, but you never factored in that situations has changed. These are some of the things that should have been avoided if you had met with your accountant or your CPA before the end of the year to go over your finances, to go over your jobs, and just to estimate. You should have prepared your mind that, okay, my 2023 situation changed in 2024, so it's not going to be the same result. I have a good sense of where things would be. So you just avoid that element of surprise. Another good reason to tax plan is also to take better decision based on facts, figures, and not based on feelings. Again, decisions based on facts, figures, and not based on feelings. I would give you an example. Somebody met me before the end of the year, sometime last month. This person started a business. The business started in October, right? So the person set up a business in October, doing very well. From October to November, I've made some significant amount of money, right? But again, this tells me that for the person to have started in October to December and I've made this kind of money, that means next year is going to be worse. So next year, because the person would have from January to December of income, right? And the person asked me, can I buy a car, a vehicle under my business name and the rest of it? Because the person's business actually requires travels. So the vehicle can definitely be deducted under the person's business. And I was like, that's a very good idea for you to buy a vehicle, but can you please wait until January to buy that vehicle? Because if you made this money from October to December, I'm sure you just started your business, so there are startup expenses. I'm sure we have enough expenses to bring down this income to zero, right? Adding the vehicle will make your expense to be a negative, and negative expense is the same thing as zero, right? So it's either zero or plus. It cannot be negative. Once you have negative, you're as good as making it zero, right? So, but next year, it tells me that for you to have made this from October to December, next year would be worse. You would make way, way more money for the full year, and then we'll be looking for deductions to take against that income for next year. So let's leave the car till January, February, anytime next year, January 1st, go and pick up the car. It's going to be a deduction from next year, right? So these are some of the things we decide when we tax plan. Imagine the person didn't come to me, the person just went to buy a car and like, oh yes, I have this beautiful car. I bought a car. I want to deduct it on my business. Many people think that once your business expenses is a loss, once it comes to negative, you probably get a refund for the remaining. No, but the worst it will do for you is to make it zero. That means you don't owe and you don't pay taxes. Then that deduction will just go when we don't need to take it this year. So these are some of the things that tax planning help you to avoid. It helps you take calculated decisions, right? I give you another example. the child tax credit is $2,000 per child, right? And the limit for you to get that $2,000 if you're filing married jointly is 400,000. So once your income is above 400,000, you wouldn't get the full $2,000, right? So you're now tax planning and you now see that your income is about 430 and you have a combination of income, or you have a combination of W-2 and business income. And there are some expenses you have to make. Those expenses you would have to make them. They are very, very necessary for the business. But it's a case of I want to make them in January, right? It's now a case of your accountant will now say, okay, we need you to bring your income down to 400,000 for you to be able to take the full credits for your child. So those expenses which you're reserving for January, can you bring them forward to December to take them down so that your income comes down and then you can have those full credits? So these are just some of the scenarios you go through in tax planning. If you also go through tax planning, some of us, we have rental properties. You have no idea how many people that have come to me and have been so shocked to hear that they cannot deduct the losses from their rental properties. But yes, you can deduct the losses from your rental properties if you make anything above 150,000. So 150,000 and above, you can't deduct those losses from the rental properties. So meeting with your accountant ahead of time helps you to strategize. Okay, I have this rental property that is taking a loss, and I would like to take a deduction for it this year, but my income is slightly above 150,000. What are some of the things we can do to bring down that income before the end of the year? Because I often tell people that after December 31st, we are out of luck. So that is why it's always necessary to meet before the end of the year and implement whatever you need to implement before the year runs out. So that's another benefit of tax planning. It enables us to take decisions based on fact and circumstances. I've also seen some people, they've told their vendors, I never advise people to do this. I'm always of the opinion of get your money when you can get your money. Some people have actually told their vendors, can you please not pay me in December, pay me in January so that I don't report it as income. And I'm like, what if January is to re-enter? If the vendor wants to pay you December, you're not going to collect your money. But I understand where those people are coming from. They don't want to report it as income because they've met with their accountant and they've seen, okay, their income is like going overboard and the rest of it. So I told them, instead, get that money and any expense you know that you would make in January or February, try as much as possible to make it now so that you will take the decision, the deduction. So that's one reason to tax plan, to estimate your tax liability, to avoid surprises, and to also make calculated decisions based on facts and figures. Another reason to tax plan is to ensure compliance, to ensure that you are compliant. Because as a business owner, there are some compliant items you need to do, and they can be done only before the end of the year. So by December 31st, you have to do that. I give you a perfect example. There was this craze of S Corp, forming S Corp and the rest of it. I don't know. I guess they were hearing it from TikTok. I see all these TikTok, YouTube, Instagram videos. From an LLC, elect to be taxed as an S Corp. That is usually the norm. It helps you save. It's tax savings. You save on social security tax and the rest, which is true and which is good. However, electing to be taxed as an S Corp comes with other compliance issues. For example, as an S Corp owner, you are required to pay yourself as the owner a reasonable amount of salary. Like if you make a reasonable amount of profit from your business, you're required to pay yourself a reasonable amount of salary. And when I mean pay yourself a reasonable amount of salary, I don't just mean transfer from your business checking to your personal checking. No, that is not salary. That is just a transfer from one account to another. What I mean is be on a payroll. Do that payroll that there will be withholding, then you will now get a W-2 at the beginning of next year. But some people don't know this. So it's when we now meet, I say, oh, yeah, an S Corp. Let me see, what is your business income like? Okay, it is X amount. I tell them, okay, then you have to run a payroll for yourself. And unfortunately, we have up to December 31st. So if we had missed that, yes, the tax return will still be done. But in the case of an audit, that is the first thing they look for. Once they're auditing an S Corp, the first thing they look for is did the owner pay themselves a reasonable amount of salary? So these are some of the things S Corp and tax planning make us to avoid. We just have to be compliant. And when you tax plan, then yes, all those compliance would be in your reach. Another practical example is as a business owner, you have employees that work for you 40 days a week and all that, but you pay those people cash or you pay them on 1099. Maybe you sell them or you cash out them and the rest of it. Most times when I discover that, I'll be like, this person is actually meant to be an employee and not necessarily an independent contractor. Because let me tell you what has happened in the past, right? This person is working for you 40 days a week. By law, the person is using your resources. The person comes to your office or comes to your shop to work for you. And all what to just do is Zelle or Cash App, no payroll, right? So the person, you're treating the person as an independent contractor instead of an employee. As an employee, you're meant to like have a payroll company and all that. I understand it's too much struggle getting a payroll, running payroll with holdings, unemployment taxes, and the rest of it. But let me tell you what has happened in the past, right? This person now gets fired by the employer. Maybe the employer says, okay, we don't need you again. Let's part our ways. The person now goes to the states to file for unemployment, state unemployment compensation. New York State will look at your records. I don't have any records on your salary, right? Because as payroll is being deducted from as pay, part of what is deducted is unemployment compensation tax. So we contribute something to our unemployment, and the employer also contributes to our unemployment. But if you're paying somebody cash or Zelle as a 1099 contractor, that person doesn't have any of those. But the person thinks he has, and he has now gotten fired or been let go, now went to apply for unemployment. And they're like, no way, we don't have your record. So you're missing out on unemployment. What now happens is the state now gets that business name, now goes to audit them, audit all of their workers. I've seen this times without number. Just that one person that applied for unemployment that didn't get it, and the person told the state, I worked for this person. I should be getting unemployment. And the state is like, your records are not there. The state now goes to the business and now audit all of their employees. We classify those that should actually be employees as employees, and they now begin to pay fines and penalties and the rest of it. These are some of the things proactively tax planning does or avoids, right? So in as much as we love those refunds, we always want to just do our taxes and get away with it. In today's world and economy, with so many things going on, so many compliance issues to think of, and the rest of it, it's not just enough to just meet January to April. You always want to meet with your accountant. I often tell people, and that's one thing I pride myself in. I try as much as possible to be as accessible to my clients as possible. Text me, call me, request for a meeting with me. I know some of my colleagues, CPA, they just do your tax return, send you papers to sign. They don't even walk you through it. You can always request, can you please walk me through? Let me know how you arrived at these numbers. Make it make sense to me. That is exactly the kind of relationship you should be having with your tax preparer or with your accountant in this case. So those are some of the reasons to tax plan is very important. So I'll just end with so to allow time for questions and answers. As we are approaching the year 2024 tax season, as we all know, tax season begins at the end of January and runs through April. What are some of the things to prepare? As we are getting our documents, send them straight to your accountant. No need to delay, no need to waste time. I have a number of people that say, oh, I like doing it first week of April and the rest. Guess what? If everybody does it first week of April or wait till like that ending of April, nothing is going to get done or your accountant is not going to meet up and finish up, right? And let me tell you a secret. I personally, and most accountants, you get the best of us that first week, second week, and at most third week of February. When you're waiting for that match, we've already done this the whole of February. We've done this the whole of March. You're now coming to meet us ending of March or first week of April. We need the money, so we will take you on. But I'm telling you that you're getting the reserve energy of us because we've already talked to so many people. We are already drained. We are already tired. By that time, we already ate everybody. So you're not getting the best version of us. And I often tell people, I don't want to be doing my taxes. Chooks will not want, I will not want Chooks to be my CPA, the Chooks of April to be my CPA, because I wouldn't want to do my taxes in that April because I am already drained and tired and the rest of it. I normally have like a cutoff. I stop accepting clients and documents. Every other person goes on extension after the cutoff. But the best practice is always once you get your stuff ready, push it over. There must be taxes. It's not a case of don't think about it. It doesn't exist. Whether you think about it, whether you don't think about it, it obviously would exist. Another thing to note for tax planning, and I really want for tax season, I really want to emphasize on this. Let's really beware of bad apples or beware of bad players out there. People that all what they do is to promise you big refund. I want us also, I know we love the money. I know we love those refunds, but let's also be realistic, right? You have W-2s. Take, for instance, you have three W-2 jobs. You don't have any child. You don't have any dependents. You don't have a business that produces losses, and you're getting $30,000 of refunds. Are you kidding me? And you're not asking questions. And you're all like, wow, this is great. Sign it, go ahead and file. And the rest of it. And you now tell all your friends, oh, that person gives good refund. That person gave me a very good refund. Guess what happens? You get your refund, you get your money. In the next 2 years, the IRS sent you a notice asking you for records, auditing you, and that person that prepared your return is nowhere to be found then. I said I was going to emphasize on this because the number of people this year that reached out to me with 2021, 2022 tax notices, it was really alarming and very disturbing. And when I asked for a copy of their prior year tax return, I asked them, okay, this deduction the person took, do you have proof of it? They will be like, no, they don't. The person just made numbers. I was like, yeah, but you got 40,000 of refund, 50,000 of refund. How do you think that is possible with your situation? Why didn't you ask questions, right? So John can testify. What I normally do for my first-time clients and anybody that is interested going forward, after I'm done with your return, I sit down with you, I do a Google Meet or a Zoom, and I walk walk you through the return line by line to tell you how I got the numbers. I don't just tell you, take, sign here, boom, and the rest of it, and you go. Only if you are not interested. Some people say, you know what? I'm not interested in learning. I trust you. Just do it and good and fine. But if you're really interested, if you're curious, I will walk you through. And that should be the relationship you should have with your tax person. The person should be able to sit down and walk you through the return, tell you how you got the numbers. You are protecting yourself, and I am also protecting myself as a professional. I've found that very helpful because when I'm walking through, the client now remembers, oh, I forgot to give you this document. I did not see that. The person brings it, I add it. Some people believe it or not. They tell you, oh, I got married last year. I forgot to tell you. You filed as single. I change it. I add your spouse and the rest of it. So these are some of the things we really need to be careful. Beware of those tax professionals that charge based on refund. It is against our code of conduct to charge a percentage of your refund. I don't care what refund you're getting. I don't care whether you are owing, my fee is going to be my fee. Because when you start charging based on a percentage of refund, excuse me, I am incentivized to make your refund higher because the higher your refund, the higher my fee would be. And I was just telling somebody yesterday, you want 100,000 of refund? Trust me, it's very easy. I will put the numbers, you will get your 100,000. The IRS is going to give you that money. But trust me, 1 or 2 years from now, when you've all used the money and you've forgotten about it, you will get a notice from the IRS asking you back for that money with interest, with penalties. So it's not worth it. So
So
you have
let me just
to.
stop you there for a little bit. Do they have like a statute of limitation, like number of years they could go back and say, maybe 7 years? How do they
Yeah, so of course, for fraud, there is no status of limitation for
for
fraud. They
fraud?
can
What
back.
what would qualify as a fraud?
So a fraudulent return is basically maybe you impersonating somebody
Okay.
or probably putting something that is not meant to be, right?
Mm-hmm.
But for the audit of tax returns, apart from fraud, for the audit itself of tax return, you have 3 years. So once they don't come for you within 3 years, then you're safe.
Mm-hmm.
Like this year, I got people that came to me because they got notices from 2021. So people got notices from their tax year 2021 and 2022 in this year 2024. They're like, me, I don't chop the money or everything don't go. I told them take it like a loan that you're going to pay back now with interest and penalties and the rest of it. Yeah. So
What is an IRS audit?
So basically, that's a very good question. So one thing people do, so imagine you have like a W-2. Okay, let me go into details. You have a W-2 of like 500,000, right? W-2 is W-2. The document is there, right? Everybody sees it, right? Then you're now a business person. The US taxation is based on self-reported. The US trusts people a lot. I don't know why they trust. They trust you as a business owner to report the income you make, and they trust you to report exactly the expenses, no overstating of expenses and no understating of income. So they trust you to do that, right? So there are cases whereby you make 500,000 of W-2. You will now say business loss of 200,000, right? So that's your return now comes down to 300,000. The IRS can say, no way, this 200,000 of business loss is suspicious. They will now go through the items. They will probably see, oh, you took car and truck, 70,000. You took travels, 50,000, right? They will now send you a notice. We are auditing your 2023 tax return. We saw you took car and truck 70,000. You took travels 50,000. Can you please send us proof of all those items? right? So an audit is just basically asking for substantiation of what you put on your tax return. That's why when I was introducing myself, record keeping as a business owner is very important. It's very important to keep your records. It's very important to keep your receipts, especially if you're traveling. It's very important to document things because you cannot just do a visit to Nigeria, a travel ticket to Nigeria. You have to show that you actually went to Nigeria for a business purpose. So communications, email communications with your business partners, and receipt of the goods you purchased while you were in Nigeria, minutes of the meeting, all those substantiation to show that this meeting was very, very important. And the only way I can take this meeting is by traveling. Otherwise, they will just assume you went on vacation and you're taking it as a business expense. So an IRS audit is basically asking you for substantiation of some of the things that you put in your tax return.
I remember the first time I met you, and I remember this vividly. So you were like, everything is deductible until, oh, well, every deduction is right until you are audited. I remember that vividly because I mean, when you go to the world of YouTube and all this kind of stuff, right? They will tell you, oh, you can deduct literally everything, and under the right circumstances, that might be possible, right? But when I heard that, I was like, okay, this is kind of a reality check for me, you know. And have you had clients go through audits, and how is it?
Okay, so I would pride myself in I've just had only one client go through an audit. That is a tax return that I prepared. It was an S corp client. It was very smooth. So I represented the client, right? Again, record keeping, we just show substantiation of the expenses and all that, right? We won the client, there was no change, right? There are cases that have come to me. Other people prepared the tax return. They came to me to assist them in the audit. I looked at the return. I asked them questions based on the return. They couldn't provide anything. They said they had no idea of the deduction that we are taking on your tax return by the tax preparer. And I said, let's be honest, there's nothing to represent you. You owe the money, right? So you just have to pay it. So I didn't even bother in this case. The only thing I tried to do was to request for them to waive the penalties and interest because they would ask you to pay back and then there will be substantial penalties and interest and the rest of it. So for my clients, I ensure that there is always good record keeping and there is backup. Then in the case of an audit for those ones, it is straightforward, it is smooth, and it is sweet. And whenever I'm preparing the return and when I am tax planning with you, I always have it in mind the risk of an audit. What I ask myself every single time is, if this return is flagged for audit, will I be able to back it up? Will I be able to prove it's what I did or what I signed off on the return? That is always the question at the back of my mind. And when those people come to me and I tell them, oh, go and meet the person that prepared the taxes, they should be able to represent you in the audit. And the next thing I hear is, oh, they're not picking my calls, so they're not answering my text messages, they're not answering my emails, and the rest of it. And the next thing I now ask them is, how much did this person charge you? And they call the amount. Some of them said it was a percentage of my refund and all that. And I'm like, okay, I understood what went on here and the rest of it.
And that experience is not a good one, to be honest. I think at some point in time, IRS wrote me a note that I'm owing them 2,000 something. I was like, how did I owe you people 2,000 something, right? So it
Mm-hmm.
happened that something happened when I was in school. Either I underreported something, and then the
Mm-hmm.
school sent them notes, and it happened that I didn't put it in my report. And then
Return,
they came back and levied me like a lot of money, both in penalties and then all the accrued interest, that you
Mm-hmm.
should have paid. So yeah,
Mm-hmm.
I want all the business owners out there to take this very seriously because
Not worth
audits
it.
audit is one of the worst things that can happen to you, especially for individuals that don't keep record. you know.
Exactly.
So
It's not
what I
obvious.
do is that everything I consider business expense, whenever I make it, I take a picture, upload it to Google Drive or something, and just create like a folder for 2024 or
Mhm.
2025. Upload all your stuff there because just like Chukwudi said, you want to prepare as if you are going through an audit, right? Just have that
Mhm.
at the back of your mind. And what I
Mhm.
just learned today is that they can look at your record for the past 3 years and come
Correct.
back
Mhm.
and hit
Yeah.
you with
Yeah.
taxes.
Some people think, oh, they prepared my return this year. I got my refund. I am free. You are temporarily free because they often think the IRS is not so efficient to say, okay, I got this refund return before we issue the refund. Let us look at the return. No way. Trust me, they are not looking at those returns you are submitting. They are just looking at the bottom line. This person is due a refund. Let us give the person the refund. That's why within 3 weeks, at times less than 3 weeks, you've already gotten your refund in your bank directly deposited. It is
Mhm.
now when they now sit down after the tax season, when you've already used the money and have forgotten about it, they will now go back to that tax year, now start flagging things. They will now start sending you a notice and the rest of it.
All
Mhm.
right.
Yeah,
Thank you very
Chukudi,
much.
I do have a
Yeah,
question,
go ahead.
right? So,
Sure.
what are reasonable and reasonable deduction that you can make from your LLC if you also have a W-2?
Sure. So I often tell people to see it as any necessary and reasonable expenses. So these are the expenses you make. Without you making them, the business wouldn't survive, right? Without you making them, the business wouldn't grow. So anything that is necessary and reasonable, those are business expenses that you can deduct. Again, it has to be necessary and it has to be reasonable. For
Yeah,
instance,
I wanted to ask, for instance, as someone who has, if you have an LLC that you are working as an independent contractor using that LLC,
mhm.
and you is just you, and I don't know what could constitute expenses in that
So
regard.
So let's say, so it's just you, that is you as an independent contractor, you are being paid on the 1099. Let's say if you travel for work, in that case, you travel to the work site or you have to travel to where you're going to work, you can deduct that travels. You can deduct your mileage if you drive for that work, right? If you have an home office, like right now, I am in my home office. If you have like an home office setup, you can deduct a percentage of your rent, a percentage of your utilities, a percentage of any repairs which you do. Those are necessary and reasonable expenses in that case, right? If you buy computer that you use for the job, you can deduct that as an expense. If the type of work requires you buy your own tools, you buy your own supplies, right? Those are the kind of things you can deduct in that case. But let's be honest, you can say, okay, this is December, I want to travel to Nigeria, I have an LLC, let me deduct it. The question now is it necessary for the business? How did your travel to Nigeria for December impact on the business? Did it bring in more customers? Did you discuss? So even though, I mean, people are so loose about it, right? They feel once you have an LLC, you can deduct anything, all your personal expenses. Boom, hide it under the LLC. Again, as I often say, you can deduct it until you get a notice, right? That you will now prove to them, was this necessary for the business? So you have to think it like anything necessary and reasonable for the business. Those are the things you can deduct.
Dr. Hillary, was that helpful?
Yes, it was helpful. The other thing, just a follow-up,
Mhm.
right?
Mhm.
Do you deduct mileage for W-2?
No, you don't. So that's another. So once you have a W-2, it is assumed already that your employer should provide all the necessary expenses for you to carry out your W-2 job, right? So if you're going from your house to your work, it is already assumed that that transport is already built in your pay or factored into your W-2. So therefore, that is not necessarily a deductible expense. For the federal, it's not an expense. You cannot deduct that. Some states allow you to deduct the mileage from your home to your office for a W-2 job. I know of a state like California. You can deduct that. New York used to allow it, but not anymore.
All right. Thank you very much. Tobe, go ahead.
Sure. Hi, Chukudi. Good afternoon. So, from the tax planning perspective, what are some things to consider when you're getting married? In a situation where both people have, their separate income, both people have LLCs, both people, just have already worked out single filing modalities, but then now they're getting married and it's like, okay, how do we combine? Should we combine? What are the sorts of things that we need to consider and what sorts of loopholes do we need to look out for in making those decisions?
Sure, that's a very good question. So first of all, if you've gotten married, you can't file as single. Your options are limited, either married filing jointly or married filing separate, right? Most times what I do is I work on the two scenarios, have like all income, do two different scenarios, and I go for the best filing status, right? So if you're changing from single to married filing joint or married filing separate, it's almost the same thing you would consider when you're single, but in this case, the deductions are probably higher, right? Like if you have W-2 jobs, can you have some tax savings from maybe putting more in your retirement up to the limit of, I think, 23,000 in your 401k and the rest of it, right? If you have an LLC that is profitable, can you have like some savings, some like putting into the self-employed pension plan? It's also like a retirement account and the rest, right? So it's almost the same kind of questions you would ask. What is the most beneficial? One spouse is not working, another spouse is working, right? So again, I spoke about the real estate aspect, like you have a rental property. Rental properties are usually considered passive. So meaning that the losses from the rental property do not go against your W-2 income if you make above 150,000, right? There are situations whereby you can fully deduct those losses. And one of those situations is if you are a real estate professional. So as a real estate professional, you can fully deduct all those losses. And what are some of the requirements for you to be a real estate? You must.
Go ahead.
Is everything okay? You must work a certain number of hours and the rest of it, right? So it's a case of, okay, you are getting married, one spouse is working, the other spouse is not working. We have rental properties. Can that other spouse that is not working assume the status of a real estate professional so that those losses would be fully deductible and the rest of it? So it's just basically the same thinking and the same planning question. So how I normally do my tax planning strategies is I start from the main thing, your pay stub, your W-2. We see the results. Then based on the result, oh, you're going to owe too much. You cannot afford to pay all this amount back. Then we now start making our way into asking the important questions. What are some of the things we can do to mitigate this tax liability? We check our retirement account. We check our HSA, health savings account. We check our investments. We check different things to see how we can bring that amount as low as possible.
Thank you. Tobe, do you have any follow-up question or is that okay?
No, that's okay. Thank you very much.
All right.
You're welcome.
All right. So Mike, shoot us. What do you have?
Yes, sir. Yes, sir. Am I audible? Hello,
Yes.
can you hear me?
We can hear you.
Yes, I can.
Awesome. Awesome. Thank you. First, I want to say thanks for this presentation. It's been very insightful. I've learned a lot, and I'm sure everyone has as well. So my question is, so can you talk a little bit about the importance of, as far as like the planning strategy, right? Tax planning, like you rightfully mentioned. what is importance of also including a tax attorney? I've been part of part of several conversations like this, and the presenters always talked about, listen, I'm a CPA. There are some complexities when it comes to, especially if you have like a complex, I guess, tax situation when you include like you have a business and then you have multiple, rental companies or rental, incomes and a whole bunch of complexities that goes with that. So the question is, if you don't mind, just kind of expand on the importance of having a tax attorney and of course a CPA as part of that whole gamut when you try to prepare such, or if you find yourself in that kind of a situation.
Okay, perfect. Yeah, that's a very good question. So, one thing about we are all in the United States, and one thing we would appreciate about the US is we can all be in a field and not be master of everything in the field, right? There are some situations that comes to me, even though it's accounting, even though it's taxes, and I tell them, to be honest, this is above me. I would recommend you do this and you do that, right? So, for instance, the situations I recommend, like a tax attorney or something, you are involved in international investments. You are investing in oil and gas in maybe China, in Hong Kong, in all these foreign investments, right? So in addition to what you have going on here, you also have like in international companies whereby you're a shareholder, you're a partner and brings in significant amount of money and all that, right? It's not as if I can do those. I can't do those, but like the risk is like it's not worth it for me, right? So I'm more like focused on. So in that case, you might want to like involve like probably a tax attorney or an international tax person. There are some things that also need you interpreting treaties, tax law treaties between maybe Sweden and the US or Canada and the US and the rest of it, right? We CPAs, even though we're tax people, we are not tax lawyers, right? We know the law, but at times the interpretation means different things to different people. We normally have like the tax court guidance to help us, but a tax attorney like knows all those tax laws decision and the rest. Like in your field, even there are some different types of tax attorney. There are some that specializes in like international taxation. There are some that specializes in like multinational taxation, right? So it all depends on your situation. So as once your things begin to come complex, and I've told clients, I started small, like some clients have started small with me, they progressed into medium and they just became too big. And I told them, okay, it's time for us to like cut ties. You've overgrown and you've gotten too big for me to just continue. This is like outside the scope of my work. I recommend XYZ for you and the rest of it, right? So it all depends on your situation. If you are involved in like multinationals, in international investments, in like foreign direct investments, different oil and gas, your thing just become too complex, then that might be the time you might be thinking of getting an appropriate person. Might be a tax attorney, even if the person is a tax attorney, you want a tax attorney, for instance, that is either involved in your situation, because even though they are tax attorneys, there are some tax attorneys that are involved in international taxation, some of them involved in local taxation, some of them in states in sales tax, some of them in like different states, some of them in unemployment insurance. So you don't just like CPAs, we are involved in different things, but CPA is just like the broad or the general term.
Thank you.
Thank you, sir.
You're
Okay.
welcome.
All right. So I want to move the conversation a little bit into nonprofits, charity, public and private. So one thing is that I do a lot of charity activities, but I have never been tracking it up to this year. And what happened with me was that I was doing a ton of research, and I heard this tax guy, CPA too, say that all the givings, all your charitable givings that you can actually have some deduction against your AGI, which is what is it? Adjusted gross income, right?
Yep.
So from the record, 30% of your AGI, you can deduct that, right? If you have like a private charity, and 60% of your AGI if you run like a public charity. Can you tell us how we can use like non-profit organizations? I had to open my own non-profit organization, which I run here in America and also back home in Nigeria. So basically, I just give money to my non-profit, and then my non-profit distributes the money to my church or distributes it to some of the activities that I have going on, or some other non-profit like St. Jude and some other ones. So can you give us like an explanation of how like having a non-profit charity can help us shelter some money from taxes?
Correct. Yeah. So this all involves tax planning, right? Also, so I have to say this: there is the standard deduction and there is the itemized deduction, right? There are some people that have given up to $10,000 in charity, and unfortunately, that did nothing to them. Why? Because they didn't tax plan before the end of the year. They just heard from somebody, if you donate to charity, then you will get that deduction. Why didn't it do anything to them, right? I know most people here are located in Texas. Texas doesn't have state tax, so you're losing out on that, right? Some people here also rent, right? They don't have any mortgage, so there is no mortgage interest and the rest of it. So already you have that standard deduction. For single, the standard deduction is 14,000, 14,000 something for 2024. For married, it's like double, it's 28,000 for married filers and the rest of it, right? So you already have that standard deduction that will be available to you no matter what. You already have that 14,000 if you're single, you have that 28,000 if you're married, right? Already in your buckets. Then there is what we call the itemized deduction. So the itemized deduction now includes real estate tax, real estate, state and local tax not in excess of $10,000. So you can only deduct 10,000 from that. Your mortgage interest, you can deduct 100% as long as the home costed below $750,000 from year 2021. You can deduct 100%. Then charitable donations, you can also deduct that. You can also deduct that up to 60% of your adjusted gross income. So adding those three together, we then do what? We then make you to figure out your itemized deduction. So if your itemized deduction is greater than the standard deduction of 14,000, then you are better off taking the itemized deduction, right? So this now comes to my initial analysis. Some people have donated $10,000 and that didn't do anything to them. Why? Because they're in the state of Texas, no state tax, right? They don't own a mortgage, the rent, no mortgage interest, no real estate tax to deduct. The only thing they have is like charity, $10,000. They're single, they're already getting a standard deduction of 14,000, right? So 14,000 is greater than $10,000 in this
Right.
case. So it does nothing to them. So that's one reason why you also need to like tax plan to be able to take all this strategy. So charitable comes, right? So if you want to give the charity and if you don't have all these things, you have to make sure you're giving like the right amount, which is something that is going to be greater than your standard deduction for you to take the full benefit of that. Or you consider other things you have going on. You consider like your mortgage interest. You consider your real estate taxes, but you can deduct more than 10,000, right? Then what then happens is, so there are times like I did this with you. Okay, this is the amount you're owing like $20,000. So if I give a charity of like 10,000, what happens to my amount? Is it going to come down? By how much is it going to come down? Is it worth it? So these are some of the decisions we take definitely before the end of the year to be able to mitigate our taxes.
No, one of the important stuff that I wanted to bring out here was, when I did that tax section with you, it kind of gave me a lot of clarity. I think in that tax session I had with you, if I give like 10,000 in taxes, sorry, in donation to my nonprofit, right? I could get a refund of sorry, I could save like 7,000 instead of paying taxes, you know. The reason why that is good, Chukwudi, was that, you know, this is money I am giving to my nonprofit, and by next year I still have control over how I want to spend that money, right? I could decide to give like scholarship over to people in Nigeria, or just do something meaningful with it, right? As opposed to paying 7,000 in taxes to the government. And that's the reason why we have this tax session, so that people can understand that if you have a nonprofit that you control the income and, you know, where you give money to, you could actually donate money, like donate money to the nonprofit account. It is your donation, but you still control that money where you give the money, you know, to. So it's more like, do you like giving the money to the government, or do you want to use it for nonprofit charity, something that you're doing?
Of course, yes. And this brings me to an important point that I get all the time during tax season. Most of us are Africans and Nigerians, and we know that black tax is real, right? Black tax supporting families back home. If we go to our account, we see a time that we send nothing less than 10,000, 20,000 to pay for our family school fees back home, to like support like a family member, be it a parent or somebody back home, right? And I get that during when I'm preparing taxes. Oh, I I sent money to Nigeria to my mom, to my dad, to my relative. Is it tax deductible? Can it be as charity? And I often say no, because giving money to like an individual is not considered like a charitable event or something for tax purposes, right? Okay, now let's now flip the situation around, right? Assuming I know Chukwuka John, and I know he operates a non-for-profit, and I tell him, okay, I want to donate, because it's also allowed in non-for-profit for you to decide or for you to donate with the purpose. The purpose, I am donating this money to you. I call it, I did non-for-profit class in my accounting. I forgot what they called it. You designate, like you designate the purpose I'm donating this thing to you is to do charity in Nigeria or to help the less privileged in Nigeria. And these are the names I want you to help, right? So, like, I know Chukwuka John, and I say, okay, I'm donating this to you, but we are going to have an agreement that 80% of this donation will go to like my mom, my dad, my relatives, right?
That's powerful. That's powerful.
Then 20% would be use it for whatever. But I'm designating 80% of this to right to this thing, then 20% for you to like decide what you want to use it for. Now, in that case, because you have a registered charitable organization, you have a 501c,
Yeah.
I am still getting that deduction for that donation instead of just donating directly to the person. So these are some of the ways. Like in any case, you are donating, you are giving the money to your parents, you are giving it to your students, you are helping people to pay their school fees, you are buying bag of rice to feed the family.
Yeah.
Like so, but you're not just doing it through the proper channel that allows you to take a deduction for rates, if that makes sense.
Yeah. You know, one of the reasons why I like these sessions that we do, it was last year, Chukwudi, that you said this thing. I was like, oh shoot. Because I use AfriX. I use AfriX to send money back home. And they gave me a sheet. Bro, I sent like close to 20,000 back home to Nigeria, like in one calendar year. I was like, I couldn't do nothing. I could not just withdraw that, you know, like withdraw that or add it to, you know, my tax planning session. And that was what prompted me to really, really look into like having a nonprofit that is registered to me, a private nonprofit, right? So right now, if I get those reports, you know, obviously I'm keeping all the record that the money I'm sending back home and everything. I could just easily use that and, you know, put into my taxes, and that is going to lower my adjusted gross income.
Exactly, like you would have done it regardless. So
Yeah.
it's all you're achieving the same purpose, but you're channeling it in a way that will be beneficial to you for
Yeah.
tax purposes.
Yeah,
All right.
follow up to this conversation, please. I don't have a button to raise and I'm using phone. I
Oh, sure.
apologize for
No
interrupting.
All right,
problem.
no problem.
Yeah. So and this is to both of you because I also have a private charity organization actually. So,
Okay.
but I think the issue I do have is when you are sending sponsorship to Nigeria, when you are funding all these private charity organization or giving scholarship or doing things overseas, do you necessarily have to send the money directly from your charity organization account, or even the ones that if you send it directly from your own personal account, does that also count?
I mean, the best practice would be to try to separate it from your personal, right? The best practice anywhere, even as a business owner, best practice is always have a business account for business expenses, have your personal accounts for your personal expenses. The best practice to for non-for-profit is have your non-profit account, put in your non-profit account, disburse from your non-profit account. That is always the best practice. It makes accounting easy. It makes the suspicion, doubt goes away. It's just easy for you to keep things clean. So my
That's
advice would always
Yeah.
be to say things
Dr.
from it.
Hilary, this is what I do, right? Obviously, I opened a US bank account, which is very good for nonprofit. So I donate into that account, right? I also use this application called Give Butter, and I mapped it to my US bank account. So I can use my credit card and donate to my nonprofit. I get my points and all those type of things, but that's another conversation. But the idea is that all the money flow from the nonprofit. So all the money I give to my churches and everything, so that there will be record. Remember what Chukwudi said, right? Do your stuff as if you are being audited, So
yeah.
keep those record. And then whenever I send money to anybody using AfriX, I usually leave in the comment section what is the purpose of that, right? And whenever I send that, I take a screenshot and upload that to my Google Doc just to keep a record of the amount of money that is flowing out and what is the purpose. So just do everything as if you are being audited, keep record as much as possible. And what he said, separate everything, separate as much as you can, if possible. Does that help?
Okay. Yeah, send me the link of that because I have multiple this thing that I typically use to send money to Nigeria, but I'll probably have one designated because I use Linfi, which is good.
Okay.
Fine.
Yeah. So, but I use Linfi for my personal use. So if I'm using it, if I also connect my nonprofit organization account into it, then it's going to model the whole thing. There will be no that separation.
Okay.
So in order to have that separation, I'll probably have a dedicated a channel through which I could send money to Nigeria. Maybe I'll probably use that one that you're using. Send me the link and
No
I could
problem.
open up
No
with that
problem,
one too.
Dr. Hillary. I'll connect with you after this. All right,
Yeah.
Toby, go ahead.
Yeah, I had a follow-up question with regards to the nonprofit. So, do you have to register the nonprofit here in America, or do you have to register it back home? What does that look like?
Yeah, it has to be a US entity. It has
Yeah.
Okay.
to it has to be
So
a
it's
US entity. You have to obviously register it with the states. My own is registered with the state of Texas, and
mhm,
then IRS has to recognize it. So I use an attorney to open this. I think you can do it yourself. But I used an attorney just to help with the whole process. So you have to file an application with IRS, and they will send you a letter that your organization, obviously, you have to state the purpose of what you are going to be doing, and they'll send you a letter with a confirmation number that your 501c organization is IRS recognized.
great. Okay.
Mhm.
Okay. Thank you.
Yeah.
Yeah.
And the
Yeah. So the
beauty,
fact that it's registered in the US, it also doesn't mean that you cannot do charity outside, right? So even though it's registered in the US, it can benefit the indigenes of Nigeria. It can
Yeah.
benefit other countries. Yeah.
Okay. Thank you.
You're welcome.
All right, guys. Any more question? Why they think about that? So I asked you this question last year. Somebody making 100,000. What are some of the strategies you are going to suggest? I want you to touch on the HSA,
Mm-hmm.
FSA,
Mm-hmm.
401k and all
Mm-hmm.
those pre-tax deductions and all that. If you
Okay.
could touch on that, thank you.
Yeah, perfect. Yeah, first of all, you want to make sure your withholdings are okay because I don't, I see people feel tax exempt from their W-2 when they feel that W-4, like tax exempt, give me all my money, don't take anything, right? So you want to make sure that you're preparing your taxes right because it's easier when they are collecting it in bits than when you have to pay like a lump sum, right? So make sure your withholdings is correct, right? And some of the things you can do, you already mentioned some HSA, health spending account, FSA. I think there's a limit. I think it's like 3,850. And there is one that is use it or lose it for the end of the year. I think, okay, somebody corrected me the last time, so I don't want to mess it up again. So I think one, either HSA or FSA is the one that you must use before the end of the year. I think it's HSA
HSA,
because
yeah, HSA.
exactly. My doctor, I was discussing with some doctors and dentist clients yesterday, and they were like, this period is very busy for them because everybody wants to make sure they've used up their HSA.
Mm-hmm.
Everybody's all going for their medical appointment and their dental now. So it's really their busy season. So you must use the HSA before the end of the year, and FSA, you can always carry it over, right? Also, your 401k, you can max your 401k. There is the traditional and the Roth. The traditional is basically you get the pre-tax benefits now, but when you begin to distribute on the money, you will have to pay taxes on it. The idea is by the time you start collecting the money, you will not have so many things going on. You will be retired, so your tax rate will be low. There's also the route. The route wouldn't give you a benefit right now, but when you start recollecting on the money, you will get the tax benefits then. The idea for the Roth is you are doing a lot of investment right now. You are securing your future and your retirement. So when you retire, you will have a lot of things to cash out on. There will be lots of cash. So you need that tax savings, right?
Yeah, yeah.
So you don't want the Roth, your 401k to be taxed. So there is no wrong or right approach. It's all based on your own approach and your personalized approach, right?
Okay.
Some states, if you're also in a state, you can also consider the 529 college savings. I know for New York, you can contribute up to $10,000 for your child in college savings, and either your child or anybody, your nephew, your niece, doesn't have to be a child. You can contribute up to $10,000 and you will not be taxed on that $10,000 for the state of New York. Some states also have all those kind of one-off tax savings and benefits.
All right. How much do you know about oil and gas?
So it's basically like, so not much. I know like, okay, so oil and gas is not something like I do like in Tonto, but I say in Tonto. Excuse me, please. So yeah, so I know like the generics of it, right? So it can either be a passive kind of investment or an active kind of investment. And based on that classification, that is then when you decide the tax deductibility and the rest.
Mm-hmm. Okay. All right.
Mhm.
Great. I'm going to ask you one more question. If anybody has any questions to ask, please go ahead. We are approaching the hour here. We'll have like 9 more minutes to end this conversation. But I want to pick your mind on what you think, the next 4 years is going to be with Donald Trump's presidency and how that is going to impact our taxes. So I know I follow you on WhatsApp. I know your political affiliations, but but what do you think? How is Donald Trump's presidency going to impact our taxes? What are your thoughts and observations?
I mean, I feel it will be good for the rich. It will be good for the top 1%. Their taxes would be lower. It will be good for businesses. I've never been a fan of trickle down, but I know the Republicans and Donald Trump believe in like trickle down, reduce taxes on businesses, like bring the tax rate. I think they brought the corporate tax rate the last time to 21%. And the idea behind that trickle down is always that if businesses are not paying more in taxes, they will be able to invest in their workers, invest in their employees, maybe give their employee raises. So I think I see them trying to go for that tax cut for, of course, for the rich, for the businesses. Unfortunately, I don't see the middle class getting any benefit from the tax cut. So I'll say Donald Trump's presidency would be a good time to own the business. It would be a good time to benefit from that 1%. I don't know if it's going to trickle down to the individuals. And the tax cut of 2018 expires in 2025. So if Congress doesn't renew it, we should expect our taxes to go higher in 2026.
Okay, say that again. The tax what?
Cut. So if you remember Donald Trump's first year,
Okay.
so there was a tax law that was passed. So
Okay.
that tax law gave like 20% additional deduction to like small business owners and
Yeah.
all that. That law wasn't made permanent. It
Okay.
was made to offset in 2025. So it would expire next year. So
Is it the
Congress, we have
same? Is it the same tax law that pegged the corporate taxes at 21%?
correct, yes.
Oh, okay.
Yeah, so that same tax law. Yes, but that 21% is permanent. So it
It's
made all
permanent.
those provisions permanent.
Okay.
But the middle class provisions, like on the small businesses, the 20% qualified business income deduction, for instance, right? So that middle tax provision, and I also think the tax rate for individuals also came down,
Okay.
right? So all those provisions we are meant to expire in 2025. If Congress doesn't extend it, our tax rate is going to go higher. Only if they extend it. That's something to really prepare for. Personally, I don't think they would extend it because the corporate tax rate came down and it's permanent. To
Okay.
me, I feel the Republicans care more about those at the top with the argument that it will trickle down. Has it been trickling down? I don't know. I just think they get more private jets, more fancy cars, the board of directors, they
Right.
just become way better off and don't pass on the savings to their employees.
What
So
do you
yeah, but
think?
I think it will be good for businesses, it will be good for investors. It's going to cut a lot of red tapes and regulations.
Yeah.
Those regulations, they are also good in a way.
Mm-hmm.
So I don't want to live in a house, for instance, that is not insulated or that was not like inspected and the rest by the city or that so many red tapes. We also have to consider our environmental factors and our survival apart from the tax or the economic consequences behind
Okay.
those regulations.
All right.
What
Chukwudi,
does
thank you.
anybody think? Does
I
anybody want to share very quickly, if you don't mind,
share
John,
what?
what they think the next
Okay.
four?
Oh, yeah, 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 yeah. Yeah. So, guys, what do you think about, Donald Trump presidency? Do you think it's going
Mm,
to favor W2 workers? Just raise your hand and
yeah.
I'll call you up.
Obina said if we impose tariffs for Canada, Mexico, and China, it's not good for consumers. Yeah.
Yeah.
So that will be on the prices of things. He said it might get rid of the child tax credit. I don't think so, but I don't think it's going to increase it. The child tax credit is currently at $2,000. I think it
Hey,
will
child.
remain 2,000, yeah, per child.
Okay.
It will remain $2,000, but I don't think it's going to go any higher. Kamala said she would increase it to 3,600.
Hmm.
I don't think it will go higher. On a more serious note, I don't know if I want it to go higher because let's be honest, those are some of the things that causes inflation.
Mm,
More money means prices because the prices we will not be really better off.
hmm.
Prices will just increase because everybody will want a piece of the pie.
Right, right. So talking about inflation, do you think the marginal tax rate is going to adjust to inflation? What do you think? Is IRS going to release to us a new marginal taxes?
So the tax rate is not going to be affected, but what they normally do is like they raise the standard deduction. So I
Okay,
think the standard deduction increased significantly higher than other years,
okay.
just to adjust for inflation. So some deductions would increase and the rest just to adjust for inflation.
Inflation. Okay.
Mhm.
Chukwudi, how do people reach out to you? How do people connect? Some individuals here might want, like, I think this year you and I did like two tax sessions where you got my W-2 and you projected how much I'm going to make at the end of the year. I'm using, yeah, pay stub. Why do I keep saying W-2? Oh my goodness. Pay stub, yeah. And with that, you were able to help me to, move money here and there. And guys, this is how the strategy works, right? That was why I was able to open a nonprofit because I saw the benefits that it could have on my taxation. So how do people connect with you? How do people reach out?
Yes, so in the chat, I just posted my phone number. So feel free to copy the phone number and give me a call. You can send me a text, right? So how I operate is basically I try not to charge. I don't, so most CPAs they charge hourly and the rest of it. I try not to charge hourly. So I just charge you one time when I prepare your tax return, and I let you know that that fee covers your annual tax meeting. So it covers the preparation of your tax return. Then you're also entitled to meet at least four times in a year, every quarter after the tax return to discuss your situation. You can call me up whenever you want at no extra costs. Ask me any questions from the fly at no extra cost. So I don't charge for every meeting we do or every session we do. I just charge you like a fee. I try not to see myself as a tax preparer, even though the ultimate goal is to prepare your taxes. But I see myself more as a tax advisor than the tax preparation is just like complementary. So I want to be involved in your entire finances and not just preparing your taxes and saying, okay, bye-bye, see you next year until tax season. So I try as much as possible to relate with you all through the year so that we can have a better outcome as a tax season. So my number is in the chat. If you reach out to me, if you want a tax planning session before the end of the year, we can meet. I'll get your pay stub. I estimate it's complimentary at no additional fee. And then I'll tell you what my fee would be based on your situation for preparing your taxes. And also it will cover the year-long consultation and the rest here. So my first name is Chooks. You can call me Chooks. And my last name is Ononye. I posted it on Ononye. I posted it on the chat as well. So the full
Everybody's Americanized already. Oh, none yet.
okay, you have to pronounce your name. So
All
feel free
right.
to out to me.
It's been a great session. I'll leave with this thoughts. Um so this event was put together by Synergy Hangout. It's a group for young professionals that I put together in Dallas, Texas. So sometime last year I asked them a question. I was like, if your tax planner charges you $500 per hour, would you do that? And that kind of spiraled a whole lot of conversation in the group, right? But the truth is that we pay a lot of money in taxes and we don't even know, you know. I would
Mhm.
rather pay $500 per hour to somebody that can help me save
Hello?
6,000 in taxes at the end of the year,
A
because that
win-win.
that 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 money is worth it. That money paid for
Hello?
itself, you know.
Sorry, is she driving?
Okay, I'm gonna mute. S. Martin. So, but that money eventually pays for itself, right? And here Chukwud is giving you guys like a complimentary um review of your tax situation. I would say go ahead and take it. He's not going to charge, and he's not binding a cuff on you that you have to pay for his services. He says after reviewing your stuff, then he can project to you how much he's going to charge you.
Yeah.
So
It's okay. It's okay. So it's a case of reach out to me if you need help having
yeah,
an idea what your result would be. Even though you don't use me to prepare your taxes, that's
yeah,
fine.
yeah,
That's okay. Okay, so you are not bound to use me to prepare your taxes. So
yeah,
I'll do that at no cost. Then you can decide how you want to move forward. If my cost is not favorable to you,
yeah.
that's fine. I'm not going to say you have to pay because you're not using me. No.
I like that. No, thank you. Thank you for that offer. Um, yeah, guys, so we've come to the end of the session. I hope this has been very impactful and knowledgeable to all of you guys. So this meeting was recorded. We're going to be posting it on YouTube right later on. So for the individuals that didn't watch it, so I want to thank everybody that joined. Thank you all the people that asked questions, all the contributors, and we appreciate you all. And do have a blessed December and the blessed rest of the year. All right,
Thank you. Thank
take care.
you.
Bye bye.
Bye.